Why do private equity firms consistently buy franchise brands instead of independent businesses? And why do they almost always buy multiple franchise brands together instead of just one? And more importantly, why are franchise founders and platform owners walking away with 8-figure, 9-figure, or even 10-figure exits, while most traditional business owners almost never do? I'm Justin Kaiser, co-founder and CEO of Empire Franchising. Over the last 24 years, I've built, scaled, and exited franchise platforms. I built my own franchise brand from scratch, installed our growth strategies, and scaled to 100 plus franchise locations in just 3 years before an acquisition. I've seen firsthand exactly why private equity loves franchising and why they acquire them in groups instead of isolation. I still get emails every single week from potential buyers, even though I sold it over a year ago. Now, if you understand this, it will completely change how you build your business, because the goal is not to build a location. The goal is to build a platform. And private equity doesn't buy locations. They buy platforms. They buy systems. They buy scalability. They buy predictability, and they buy leverage. Franchising gives them all four. You see, private equity firms are not emotional buyers. They're mathematical buyers. They look at risk. They look at scalability, they look at repeatability, and they look at return on capital. Franchising is one of the most efficient business models ever created for converting a proven model into financial leverage. This is because the franchisor doesn't need to deploy millions of dollars to build locations. Franchisees deploy the capital. Franchisees assume the operational risk. Franchisees hire the staff. Franchisees sign the leases. Franchisees manage the day-to-day operations, while the franchisor owns the system, the brand, the intellectual property, and most importantly, the royalty stream. And that royalty stream, it's recurring, it's predictable, it's scalable, which is exactly what private equity wants. Imagine two businesses. One is a restaurant company that owns 50 corporate locations, and the other is a franchise brand with 50 franchisees. Both generate revenue, both have customers, both have brand equity, but they're fundamentally different assets. The restaurant company must manage leases, payroll, inventory, staffing, operations, and capital expenditures. Their margins are compressed. Their growth requires capital, and their risk is operational. The franchise brand, on the other hand, generates royalty revenue from 50 independently owned businesses. Their margins are significantly higher. Their capital requirements are significantly lower, and their risk is distributed across multiple owners, which means their cash flow is more stable, more predictable, and more scalable. And predictability is what drives valuation. Private equity doesn't pay for effort. They pay for predictability. They pay for systems that can scale without proportional increases in cost. They pay for businesses that behave like platforms instead of operators. And franchising is one of the cleanest platform models in existence. But here's where it gets even more interesting. Private equity rarely buys just one franchise brand. They buy multiple franchise brands and they roll them up into a portfolio. This is called a platform strategy, because once you have the infrastructure, once you have the leadership, once you have the franchise growth engine, once you have the marketing systems, once you have the legal infrastructure, and once you have the operational playbooks, adding additional brands becomes exponentially more efficient. You're no longer building from scratch. You're duplicating infrastructure. And duplication is where the real wealth is created. Let me give you an example. A private equity firm might acquire a home services franchise brand, then acquire a complementary brand in HVAC, then maybe plumbing, then maybe electrical, and maybe restoration next. Now they have a portfolio of franchise brands that all serve similar customers, similar operators, and similar infrastructure. They can share leadership. They can share marketing resources. They can share franchise development teams. And they can cross-sell franchise opportunities to existing franchisees, which reduces customer acquisition costs. This is why private equity buys franchise brands in groups, because once that infrastructure exists, every additional brand increases efficiency, increases revenue, and increases valuation. And this is exactly how billion-dollar franchise platforms are built. They're not built by owning locations, they're built by owning systems. And here's something that most founders don't realize. Private equity is not buying your current size. They're buying your future scalability, and they're buying your system's ability to grow, and they're buying your infrastructure's ability to support expansion. They're buying your platform's ability to duplicate. Because a franchise brand with 30 locations that's structured properly, with clean systems, strong unit economics, and scalable infrastructure can be more valuable than a business with 100 company-owned locations. Because the franchise brand has leverage, and leverage is what drives valuation. This is why private equity firms look for specific indicators. They look for strong unit-level economics. They look for predictable royalty revenue. They look for low franchisee fail rates. They look for scalable systems. They look for brand differentiation. And they look for leadership teams that understand platform thinking. Because platform thinking is fundamentally different from operator thinking. Operators focus on running locations. Platform builders focus on building systems. Operators create income. Platform builders create equity. And equity is what private equity buys. This is the shift that every founder needs to understand. If your business depends on you, it's not a platform. If your business cannot scale without deploying capital, it's not a platform. If your business cannot duplicate without friction, it's not a platform. Private equity buys platforms because platforms can scale exponentially. This is exactly what we focus on at Empire Franchising. Not just franchise brands, but franchise platforms. Systems that can scale, systems that can duplicate, and systems that can attract institutional capital. Because institutional capital flows towards scalability, predictability, and leverage. And franchising provides all three. So if you're building a business today, ask yourself this question. Are you building a location or are you building a platform? Because one creates income and the other creates equity. One caps your upside and the other multiplies it. And private equity has already answered this question. They are buying platforms, they're buying franchising, and they're buying scalability. If you want to position yourself for that level of outcome, you need to start thinking like a platform builder. Build systems, build infrastructure, build duplication, and build ownership. If you want to learn exactly how to structure your business to scale through franchising and position yourself for private equity, then visit empirefranchising.com and schedule a growth strategy session with us and subscribe to this channel. Start building your platform today. And if you're an investor who wants to learn more about how you can have equity in multiple franchise brands, then contact us today as well.